Hey everyone, nice to meet you all. We have an exciting panel today. I will kick it off with a quick introduction on myself and then turn it over to our lovely panelists. My name is Omar Kanji. I'm a partner at Dragonfly. We're a global cross-border crypto fund, and we invest all across the world and across stages. And so, time to introduce the panelists. Jared, why don't you go first?
I'm Jared Hutchings. I'm the founder of Pure VC. We were established in 2008, did traditional venture from '08 to 16, and crypto since 2016.
Hey everybody. Hey everybody, my name is Thomas Chen. I'm the CEO of Function, joined about 4 months ago. We are an asset issuer for FBTC, which is a wrapped Bitcoin product. Previously, I spent about 7 years at BitGo, leading global sales and everything crypto native.
And I am Max Bareiss, the head of lending at Galaxy Digital. Big day for us tomorrow. We're uplisting on the NASDAQ.
Yeah, it's going to be a big day. Okay, so why don't we kick it off with just a giant state of play. So I would love for you guys to walk the audience through what is the current state of play today in the risk space, in the yield space, sorry. How does it look like across funds? How does it look like across protocols? What are the current opportunity sets? And so kind of just open up the floor to give the audience an overview.
I can start from the protocol side. Just, I went, was at Token 24 in Dubai. I went to too many conferences to count. And at BitGo, I had a front row seat into all the different protocols that wanted a custodian, right? So in looking at the yield, different types of yield plays, in my head, there's really three. There's the baseline yield from protocols. That's like securing the network, lending. Then you move up to like structured. So that's like vaults, right? You have some more engineered risk. And then you have incentives, which now seem to be the hot thing with points, right? But really what it is just customer acquisition costs and inflationary tokenomics. So those three are the ones that I see. The interesting observation that I also see is funds are very focused on the structured part. The protocols are very focused on the base one and the incentives. And there seems to be a friction or hard time having everybody moving across the different levels of yield layers. And so what we're trying to solve, especially for Bitcoin at least, is to make it super easy for funds to use BTC across the different yield layers.
Yeah, and I'll kind of tackle it from the centralized side of things. So borrow lend obviously is definitely like the main yield generation strategy. You can also sell covered calls as another yield generation strategy. But with respect to like where the yield comes from, I think most people look at the basis trade. That's sort of like the easiest way to deploy cash in a delta neutral fashion, get yield. You kind of look at the funding curve, and that sort of sets the lending rates just across the ecosystem. You can look at the 1 month, 2 month, 3 month, and there's a fair amount of liquidity where you can basically source cash to that.
I would just add, we've talked about funds and protocols. I would say for retail, retail really got excited during this last cycle. I think the BlockFi and Celsius and leverage, in the system drew a lot of people in, and rebuilding from that with high integrity yield. As I think is really the current state of play. We're in a place where like, hey, we could see the dangers of leverage. We could see where hollow yield or fraudulent yield was advertised, and now is the time to build projects that have high integrity yield.
Totally. We're getting flashbacks to Terra right now.
Yeah, but I mean, I'll kind of add to that. I think that it's a little bit more of a sophisticated industry now. People are asking the question of where the yield comes from, and I think that's the most important question. If the answer isn't super clear, probably don't want to put your capital there.
Yeah, I've already had so we ask that question often, and we're often underwhelmed by the answer. So it is the most important question to ask, because if you don't know where the yield is, then you are usually the yield. But someone actually, we were just talking right before this panel and said, asking where the yield. When yield is introduced, what that means is risk is being introduced. And crypto is obviously doing this really interesting thing to finance that happened to media. There used to be a few network channels there was a limited offering, and crypto, with the ability to tokenize and the ability to create these trustless marketplaces, is going to create this Cambrian explosion of what can be offered via yield. That's a good thing. We should be excited that there's going to be this huge explosion in what's offered and where's the yield coming from, and that's going to be create a lot of exciting options. What we also need to be is very circumspect about where those things come from. One of the ways we're trying to address that, we just funded a company that's seeking to price the risk of on-chain yielding assets and on-chain real-world assets from depegging from either their stablecoin peg or in the future their yield. So there should be a mechanism on-chain ideally, but a mechanism in the ecosystem to actually just price this risk. Some equivalency of community notes on X where people can say with their dollars or ideally or with their words like, hey, here's what we think about the integrity of the yield of this product.
Totally. Yeah. I think, very good points, and we'll touch on some of this later on, but maybe just to continue down this state of the overview, how would you guys articulate the current landscape in terms of yield opportunities? What are the current prices of yield out there in the market? What does the yield curve look like across structures, things that are on-chain versus things that are off-chain? Like what's the lay of the land?
Yeah, I'd probably have the best, finger on that one. So I think cash right now, everybody always looks at the basis trade. I think short-term cash right now is relatively cheap. You can look at like Aave or Compound, and it's like 4%. I'm kind of doing that from memory. Coming to like a centralized player, I think you have some big counterparties that have a large market share, and they're pricing somewhere around 7%, up to about 12-ish to 12.5%. If you go out the term structure, you can't create cash as easily outside of 3 months because you can't do like the reverse basis trade, which is selling Bitcoin and buying the futures market outside of 3 months. Bitcoin, I think what I've been hearing around the ecosystem is that the borrow rates unsecured are roughly 5%. And then ETH is a little bit higher than that, just given like the nature of kind of where that's at. And then Solana is pricing a little bit north of 10%, and that's higher staking yields. And then there's a decent amount of the staking providers that are willing to pay incentives, and I think that there's a lot you can do with stake weight.
I want to touch on the on-chain endogenous DeFi a little bit as well, because I feel like DeFi has created this perverse incentive mechanism where you have a lot of these very large, call it restakers, where they've already set the expectation for yield, and they have to constantly feed that machine and that narrative and service the returns on that growing pool of TVL, right? And so in order to do that, they almost have to start looking at things that are further up the risk curve. That, and coming from Token 1209, I heard some use cases that are just completely new that didn't make any sense to me, but they were very confident in their delivery of like, this is the next wave of how we can service and scalable or service this yield in size.
Yeah. Okay. So I think I totally agree with what you guys have said. What do you guys think is like sustainable versus unsustainable? I think like this idea of just token emissions for depositing into a protocol, can be construed as like, oh, the yield is coming from this token that I'm minting out of thin air. But at the same time, some of these tokens might have some type of underlying value accrual mechanism. But and just to take the complete opposite side of it, collateralized lending is relatively straightforward. There's a price on risk. It's easy. There's low LTVs. Like it's very simple to wrap your head around. How do you guys think about what's sustainable, what's not, what's a good yield, what's a bad yield?
So yeah, I'll hop in on that one. I think, well, 2 points. I think one is it's probably fair to say that the kind of yield rates that we're talking about so far about high integrity yield is it's probably in that range. It's in that lower single digit or mid single digit range when people are talking about, oh, I'm getting yield of 10 or 20 or 30%. Then that should obviously raise some amount of concern. For us, we backed a different project that's a composable DeFi layer that's aggregating high integrity crypto primitive forms of yield, and those I think are either those are coming from the things that we know within crypto to be either a utility that's producing like a Uniswap, Compound, Aave that's producing some kind of yield, and they're packaging that into a composable layer of DeFi. I think those things, especially you're getting a diversified basket of crypto primitive forms of yield. Those things I think is a sustainable way, and that's powering a lot of things. That's powering a lot of things in crypto right now. They're almost 3 billion in TVL. I think that you're going to see some of those maybe come in and out of the basket over time, but I think having some basket of high integrity form of crypto primitive yield is probably going to be sustainable as long as people are using Uniswap and using Aave. These things have fundamental physics of business reasons for why that yield is created.
Yeah, and I guess sort of a different thread, but similar. A lot of the yield generation can be kind of implied via the funding rates. So if you just kind of look at the perp market, you can essentially create any token delta neutral by buying it and selling the perp, and that functions as an open term loan. And you can synthetically create any asset you need, and then that essentially just becomes like almost a fixed for float rate swap if you then use that and lend it out.
I think a lot of projects are also playing the game where they almost have to, from token emissions or incentives, it's almost unsustainable until they figure out a dApp or some dApp lands on the chain and it becomes sustainable, right? So they almost have to feed the perception that there's activity on the chain until somebody builds a real use case or there's actually economic activity that's happening.
Totally. Okay, so maybe like continuing down this thread, but we've touched on a couple of the topics that are interesting, which are, synthetic yields that are created on venues or some of the stuff that's happening on chain with respect to restaking. But what would you guys say is the most innovative stuff that we've seen so far in the last couple of years that has entered the yield space, both from an institutional and retail perspective?
I think RWAs, and I think that the sophistication there, where Galaxy is launching a CLO with Arch Lending, so their retail lender. We created the SPV, and it's essentially where the yield's coming from, but you're seeing a lot of like innovative stuff sort of hitting some of the morpho vaults. I know that recently you had the Apollo CLO that's also now in a morpho vault, and that's a big brand name, like big time institutional player coming and starting to partner with some of the DeFi players. So I think that's what's kind of caught my interest lately.
For me, it's composable yield structures. I think in DeFi 1.0 or 2.0, you had vaults where you deposit a certain asset and accomplish a certain strategy. Now we're getting to a point where these vaults are getting more complex. They're more modular. You can actually tokenize these vaults and do other things with it. So I think maybe you said it earlier, like I think DeFi is getting more complex, but the users are getting more simplistic, or they demand some sort of user experience that's a lot more straightforward. So we need to figure out how to bridge that gap. But I do see composable yield as the new emergent thing.
Yeah, it's interesting that yield was such a lure for so many people in the last cycle, and yet you still have these two dominant stablecoin providers that don't pass the yield forward, and people are fine with it. They're like, okay, I'll still use these.
I think that's an accessibility thing, right? Because would I rather get 90% of the treasury rate back to me, or should I keep it in USDC for the right opportunity that can give me 300% return?
Yeah, I think it's also just like a securities laws and regulations thing for why they don't pass the yield back. Obviously, a number of protocols and companies have decided to go and issue in certain jurisdictions in order to do that. But
no, I know why they don't. I'm saying why don't they seek alternatives? There's alternatives.
Oh, yes. No, agreed. Okay, so this is actually a good point and a good segue. Why don't we switch over to the risk side, and how do you guys like evaluate the risks? And so there was a comment made earlier about Uniswap and Aave and Compound and some of these larger battle-tested DeFi protocols that have been used to largely generate a lot of the yields that we see across the universe today. How do you guys evaluate risk across the spectrum when you're looking at on-chain yield sources? And then, now some of these on-chain yield products, like the Apollo credit piece, has like a whole off-chain component where the underlying risk is actually in the real world. And so how do you guys think about the different structures and the different opportunities, and how do you guys evaluate it all?
Yeah, I'm happy to hop in. I mean, we're very boring, like simple VCs. We spent 8 years in traditional venture with this firm before we migrated to crypto. So we're a very fundamental physics of business, a venture fund, and we start with this question of, is there a product somebody's paying for? Like, it's a very simple thing, but ultimately, like, there really needs to be some genesis for that yield that makes sense. And I'm excited about the weird alien, the Cambrian explosion of all kinds of things that are going to come, and some of those are going to be high integrity, but we're pretty simple that way.
We're also pretty simple. We are just an asset issuer, right? We're not putting together the strategies or anything. We just want to make sure that the asset backing, and that for us is BTC, right? It's one-to-one. It's verifiable on chain. You can see it's not being put into some startup's multi-sig or omnibus wallet. It's one-on-one, and it's also governable. So it's whitelisted for certain specific activities that we can verify. And then the rest is up to the DeFi teams to become creative and create these new primitives.
Yeah, as a publicly listed company, risk is relatively low. We're fairly hypocritical. We normally require people to lend to us unsecured, and then we lend over collateralized. So, and analyzing the risk is literally the trade. So we're constantly looking at that. I could talk about risk for like an hour straight. But it's taking a look at what is the largest move that Bitcoin has versus the pair you're lending against over a 24-hour period, which is your margin call window, dating back to 2020, which was the largest move that we had seen in the market. And then taking counterparty exposures is like, it's weird because everything's over collateralized, and yet we're still making sure that like we understand the actual balance sheet. What is the net equity of the actual company that you're looking at, not the assets, and just kind of doing that analysis. And then you can play around a little bit with the LTV because of that. But that's sort of how we analyze risk and try and do it in a way where we take as little as possible and make as much yield as possible, which...
Yeah, I think one of the things we haven't seen so far this cycle has been the rise of maple pools back in 21, 22. We've started to see like this early signs of it with Wildcat, which is like unsecured lending on chain, like very much put money into a pool. That pool ultimately gets lent out to some counterparty, tends to be a market maker or an HFT shop, and that they go do their strategies, and their cost of capital is lower than what they're generating on the return side. And so they clip a spread, and like that's how the math works. But we haven't seen that come back in full form yet. Do you guys have a view on unsecured lending and whether or not it does come back?
I've seen some, call it, it's turning up on my radar, coming from Token 2049, and then it's coming from large guys restaking protocols that have amassed a ton of liquidity in their network, but the demand side isn't really there to service it. So all of a sudden they're like, wait a minute, I have so much TVL. I'm starting to see some other dApps come in and use that as collateral to then mint their own stablecoin and mint uncollateralized to these HFT players. So I'm starting to see it form, but it hasn't been main stage yet.
I don't know if broker to broker that's going to happen like it did. So you had like all of those players that you were mentioning earlier sort of lending back and forth with each other. We have a decent amount of ability to borrow unsecured. I think what's more important than borrowing unsecured is also making sure you have proper asset liability matching. And so terming things out, figuring out evergreen structures or whatever it is to make sure that you don't get caught with your foot in your mouth and you have a recall and you lent it out for 12 months.
Okay, so this is a good point to maybe switch over to the TradFi side, since we talked about them a little bit. But how do you guys see the state of adoption, whether that's on-chain protocol adoption, whether that's from a fund perspective? Where do you see the convergence between crypto native products and traditional financial institutions?
They're interested, but I don't think they know how to do it yet. I think they have no operational support. So you're talking to all of the large scale banks, and once you essentially had like the new government come in the US and basically anoint crypto as like a real asset, they're all interested, but it's an asset that trades 24/7. And so they're either taking incredibly risk averse LTVs or they're just not touching it because they don't know how. Like they actually can't do a margin call on a Saturday at 2 a.m. Like they just don't have the support.
I'll double down on that. And if you look mechanically, the access point to crypto for all these funds is still going to be through a custodian or through a wallet. So then it also depends on the custodian's ability to integrate natively within DeFi or create this robust infrastructure in a trust minimized way to access the yield if that's the play that they're trying to do. So yes, there's the regulatory component, there's the risk frameworks that they have to align in what DeFi looks like versus how they communicate to their LPs, but then also the underlying custodial structure and wallets that they use.
I think you've already seen it. TradFi starting to do it through acquisition. I think that's going to be the path for them. Is there have been, we had our first as an industry $1 billion plus acquisition 6 months ago, and now there have been several. So I think you're going to see TradFi get in through acquisition.
Got it. And like if you guys were to project forward, maybe if we like look forward like 3 to 5 years, where do you think this intersection sits? Obviously today, largely people are on the sidelines, evaluating the different risks, trying to build the right infrastructure, partner with the right infrastructure providers, or go and acquire certain players across the space, whether that's a prime, the whole gamut. But how do you guys think this plays out in the future?
People are going to protect their interests, their existing businesses, especially TradFi is going to figure out how do I integrate and how do I adopt all of these things in a way that I'm also not cannibalizing their existing revenue streams and their existing sources of value. I think one exciting thing in the next 3 to 5 years about this integration is coming back to what you said, Max, about RWA coming online, because I think yield from RWA combined with these crypto native forms of yield that we talked about is going to grow dramatically in its accessibility, both to people in the U.S. and outside of the U.S. Worldwide. People are going to have more access to yield, and that's such a differentiator in wealth creation opportunities, even if it's small. If you look at in the U.S., half the country that invests and half that don't, those outcomes end up being dramatic for those individuals and families. So to me, the hope is that this integration with TradFi means that really great yielding RWA projects and the high integrity crypto native projects actually have accessibility that becomes a game changer in the personal finances of people who normally only have mobile, they have a mobile phone, but they don't have a real financial wealth services infrastructure around them in their jurisdiction or their community. They now have access to yield, high integrity yield. That's a game changer for people.
Yeah, I also think, because going back to your original question, which was what's going to happen in 3 to 5 years, I think what we're already sort of seeing is TradFi's coming in. You're seeing spread compression. You're seeing healthy competition. You're going to see some of these TradFi players make big plays. So I think like a good example is Cantor's like definitely said that they're putting billions of dollars into the crypto market. That's going to create the competition. You're going to have people come in and try and take market share. And because of that, you're just going to have additional capital in the space, which is going to help create and grow the digital asset space in a really healthy way.
I think downstream of that has to be packaged in a certain way, right? I think the future of DeFi will probably look more like vaults than getting the asset yourself and then figuring out how to run these loop lending strategies. For us specifically at Function, you mentioned BlockFi and Celsius. I think this time, if you were to do it correctly, you can absolutely create an on-chain earn type account, right? That has the visibility, so they're not lending under or uncollateralized, and you have the verifiability as well. And if there's a way to have an on-chain vault for, at least from my perspective, for BTC for the masses, then that's a game changer. It's packaged a certain way.
Just like on this topic of people tokenizing products, putting them on chain, and that serving as the baseline yield for whatever ends up getting distributed. A lot of the traction today has largely sat in treasury products being tokenized, put on chain, and like that serves as a baseline rate for on-chain protocols or people that want to pass that yield back long. Where do you think, or what types of products do you guys find interesting that should be tokenized, should be on chain, and should be accessible that people actually want? I think one of the things that I see anyways is there's a lot of adverse selection, which is stuff that can't be sold through the traditional channels, ends up getting put on chain to then end up being packaged and tried to be sold in the crypto markets. Like, how do you guys see it? Do you see it differently? Like, would love to get, your perspectives.
There's so much to choose from. We see lots of pitches around these dormant real world assets like gold and diamonds that are just sitting there. Nobody's ever doing anything with these. Is there a way to leverage these assets? And then you see that actually like short-term assets that are associated with multi-party contracts that close within 30 days, then opaque markets. These are actually the ones that really need to come on chain, because you create transparency and trust, and this complicated multi-party contracts can all happen on chain. So the truth is that I don't know, is that it could be either of those, but it's definitely coming for all the above. I mean, we're at 20 billion in real world assets tokenized right now, going to, there's moon charts for this all over the place, but we're probably going into the trillions over the next 5 years.
Yeah, I think what excites me is RWAs today have largely been treasuries, like you mentioned. I think the next logical step is what's a treasury-like thing that gives you yield. So bonds is kind of where my head goes to. So cash bonds that are going to be tokenized, put on chain, but then doing more innovative things. Like for Galaxy, the currency we deal in is cash, and it's Bitcoin, it's ETH, it's whatever. So why wouldn't we issue a traditional bond that is in Bitcoin? We could borrow 1,000 Bitcoin via a bond offering, tokenize that, and put it on chain. Like that's just logical, and it's something that I think that we should do. And after the NASDAQ uplisting, it's something I want to do.
I guess if you extrapolate it further, I think instead of just looking at the yield itself, yield is probably going to get commoditized. And then I think distribution is actually going to be king. So who's going to own the front page of all of this? Full disclosure, we're backed by Galaxy, so we think they have a strong position to be the front page of all these assets, right? We're taking in Bitcoin and then actually distributing them to yield-generating products and innovative products and risk-adjusted products.
Okay, I saw we have 1 minute left, so speed round, non-consensus take on the future of the industry across yield products or anything in general. I'll open the floor.
I just think we're going to see some kind of really cool, absolutely new, interesting form of yield in a crypto asset that we've never seen before, and it will be high integrity. It'll be some totally weird thing, and we're like, actually, that works.
It's somewhat similar. I don't think it's going to be weird. I think it's just going to be really, really boring.
I'll echo that. Yeah, I think that what's going to happen is you're going to start to rebuild TradFi just on chain 24/7. Just break everything down, and it's now going to run on crypto rails.
All right. Okay. Well, that concludes our panel. Thank you, everyone, for listening, and thank you to the panelists.
Moderator. Let's go.